Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
AJ Giannone from Allio Capital. Thank you so much for joining the Contrarian Investor Podcast today.
Thanks for having me. I'm looking forward to having a discussion with you here today. I think there's a lot of opportunity out there for investors, so really excited to dig in.
That's awesome. I love opportunities. So do our listeners. And there's a couple of areas. I want to talk about high yield first. And this is something where if the U.S. is going into a recession, you typically want to avoid. We don't know if the U.S. is going through a recession. There's certainly a lot of talk about it, but there also, more importantly, has been a big move to risk off. And that would also involve getting out of high yield. But you like high yield credit, not just that, but you think that ETFs are a good way to play this asset class, and even actively managed ETFs, which flies in the face of everything I have learned about investing, especially in ETFs.
Yeah, it's interesting. To your point, a lot of investors, if you come from, the low cost passive indexing school of thought, have determined that there's really no value to be had by active management. And, in a lot of cases, they're probably right. I think the interesting thing about high yield in particular is that, especially compared to equities as an asset class, investing in credit isn't necessarily looking for the company that has the turnaround story or the business that's going to, have a massive growth in expectations of forward earnings or have a new business line or a new product line. It's really about insulating yourself from the downside, which I think is especially important with where we find ourselves in the macro cycle and the market cycle today. So with that said, I think there is an opportunity for folks now that high yield spreads have risen a little bit off of their lows. And even without that, I think there's a pocket of opportunity here where, over the last maybe 15 years since the great financial crisis, corporates have been awash with liquidity. You went through that period of ultra low interest rates. And even now, the banks and the private credit space and all these, asset-backed lending facilities, the proliferation of CLOs and all these different facilities that provide credit to these companies, it's enabled them to really shore up their balance sheets. And what that presents us with now is you're entering an era of uncertainty, of maybe elevated risk, maybe you're looking for pockets of opportunity and safety. And historically, Howard Marks, the famous investor from Oaktree, pointed this out maybe just last week in a memo. But you would expect that high yield bonds in particular would have a similar return over a long period of time as maybe any other asset class, given trade-offs between risk and return. But interestingly enough, you've seen a historical risk premium in excess of the default rate in this asset class. So I think there is an opportunity for investors to access this asset class at this period in time, particularly with an eye towards maybe a smart beta approach or an active management approach, where the manager or the fund company is trying to screen out some of those real laggards of the pack, because you're not necessarily looking for the best in breed. You're trying to exclude some of the issues that could potentially cause a problem and have a default or some sort of actual loss of capital event. So in my view, there's really a stark comparison here between an expectation of maybe an 8% forward return on some high yield credit ETFs with limited amount of downside risk and volatility, and something like going and buying the S&P at 20 times forward earnings, when you've got this kind of rollover of consumer expectations and business expectations.
Very interesting. Yeah, I've just been looking up some ETFs here where in terms of high yield, at least the beta product, the most widely cited one is probably HYG, the iShares iBoxx. And this thing has gone nowhere over the last year, up 2%, basically within the margin of error. It yields 5 and change, almost 6%. Is that enough to make up for the risk that this thing is that's involved with this?
Yeah, it's I think it is. And if you look at the 10-year return of this product, total return inclusive of the dividends is just over 4%. Now that's reflective of coming through the COVID period and part of the back of the ultra low interest rate period. So what you have to look with in this particular case with high yield, with corporate credit or anything like this is the spread over comparable treasuries. So when you went back to the ultra low interest, zero interest rate policy that predated the COVID period, you'd get a couple hundred basis points maybe of spread over a treasury, and that maybe was 3 or 4%. Here we have a situation where treasuries of equivalent maturities are yielding, over 4%. So, when you look at the spread to those treasuries, I think it's much more favorable of an environment now than it was in the zero interest rate period. You're getting compensated at both a relative level and an absolute level that I think is much more in tune with investors' expectations for forward returns for their own portfolios. And so one of the interesting things that I like to look at, and one of the things that is in fact highly predictive of forward returns, is the current yield of these instruments and the yield to maturity. So, if you look at the SEC yield of the HYG ETF, it's 6.91%. So if you buy this ETF today, based on the coupons that it's throwing off today at the rate that it's throwing them off today, over the next 12 months, 6.9% is kind of your baseline for what you could expect to earn. And, the expectation there would be that 6.91%, if the price of the ETF doesn't change, would more than compensate you for the potential risk of defaults in the portfolio, which have averaged, 3% or something like that along those lines. So assuming that we don't enter a recession, I think that number's probably low. Assuming we do enter a recession, that there are highly likely to be defaults in the portfolio. But if you compare those to other recessionary periods, I think that there's a reasonable expectation, again, that you're more than compensated for that default risk based on where spreads and yields are today.
Let's talk about some of these smart beta products. Do you like anything there in particular?
Yeah, there's a product, HYBB, which is an iShares product. It's high yield, but it's done on a systematic way where they're selectively screening for quality and trying to avoid some of the worst of pack, issues in the universe of high yield that, in their view, based on their backtesting and methodology, could potentially be higher default risk credits and issues. So, if you look at a comparative chart of that HYBB versus the HYG, which is also the iShares product, I think you won't see too much variation on a day-to-day basis, but what you will see over a longer period of time is a little bit less volatility and a slightly higher realized return. And now, will this systematic strategy work if we go into a recession tomorrow? Will it protect, against the likelihood of default from enough issuers to make up for the fact that you're maybe paying a little bit more in terms of a management fee on that product? I don't know, but I think the odds are in your favor.
Actually, the management fee appears to be less than the other one. It's only 35 basis points according to this
interesting.
Data. Well, that's the expense ratio, 0.35%.
Yeah. Interesting. Huh. Maybe they cut it recently, but that makes it an even better deal.
The systemic part, maybe it's not like the machines do all the active management, but
yeah, they work for a lower cost. It seems like
no cost.
Exactly.
Oh, that's really interesting. Okay, so that's one where you think that they're able to hedge out some of the defaults.
It's cutting off the tails basically. Totally. At the end of the day, if you cut your default rate down by a meaningful percentage, then those are in your distribution of outcomes, very acute pain points that are very infrequent. So if you can eliminate some of those, that really skews the odds in your favor to maintaining that preservation of capital component of the credit strategy.
Yeah. And you mentioned recession, and it doesn't sound like you're terribly concerned if we do enter one that this will lead to mass defaults.
No, I don't think so. The the actual, mechanism by which a company defaults in a recession, I think, is important too. When you compare where we are today to some examples of recessionary default rate rises over history, there's a high correlation between not just the recession component, but the access to credit and the availability of excess liquidity in the market that allows companies who get into trouble to refinance. And you saw this a lot during COVID in particular, where companies that had a viable business that was just temporarily impacted by COVID were able to extend, either modify or work with their lenders in a way that eliminated or at least reduced the risk of default, and basically either, call it kick the can down the road, restructure, whatever way you want to describe it. But what it meant for credit investors with it was that they got paid back at par, which is the expectation going into any credit investment that you make as an investor. So assuming that this is, an environment that leads to either A, not a recession, B, a mild recession, or C, even a moderate recession, I think there's a high degree of likelihood that the default rate of these instruments will be either average or below average, what we've seen in other cycles. The one risk to credit in these cases is that the companies literally can't pay back their bonds and can't continue to make those payments or pay them off at par. And that would only result, in my mind at least, from a liquidity crisis like we saw in '08, where there was some systemic issue that caused a lack of confidence, lack of willingness from the lenders in the space to continue to work with companies to restructure or to issue them new credit to pay off the old credit. And, to me, that comes from, those type of systemic crisis of confidence periods that are both acute, but also I think more rare than just a traditional recessionary period. So, on balance, there's I think an expectation here, no matter how bad the uncertainty gets. We've seen it play out over the last few weeks where, there's just so much uncertainty, a lack of uncertainty premium in these credits. So I think, in my mind, this is the play that you make if you think that there's an elevated likelihood of recession. It may not be totally catastrophic like an '08 or, a Great Depression scenario, but you're not comfortable with just taking pure equity beta risk.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
Let's talk about private credit. And this is interesting. This is something where it seems every day I get pitched somebody to come on the podcast and talk about private credit. And it's a huge asset class now suddenly. And my answer is that to say no, because there's no way for retail investors to access this asset class. However, that has now changed, you're telling me, right?
Yeah, that's correct. There are now seemingly a proliferation of new issues in the ETF space for private credit exposure. And it's, to be fair, it's not exactly, one-to-one the same type of exposure that you would get, if you went to a Blackstone or some of these large, private asset managers to get a private credit fund. But the correlations are quite high. The credits are seemingly from the same source, and they're managed by the same teams and desks of people who are doing the, high net worth institutional private credit side. So, to me, I've seen issues from State Street, BlackRock, Bond Blocks, a couple other ETF issuers, and they all take a slightly different approach. But what I think the message there is that, you've seen this migration again off of the traditional investment bank being the default choice for companies to go get financing. So, historically, and especially pre-08, that was really the one-stop shop for companies to get financing. And now, with the reduction in their ability to take risk and to add leverage to their balance sheets, you saw some of these teams and these experienced professionals move away from the investment bank side over to the asset management side, which is now, created a proliferation of expertise over on that side, which I think as an investor myself, I look at this asset class in the ETF space and say, this is fantastic. I think, that there is certainly an element of risk that you always have to be cognizant of, but as part of a diversified portfolio, there's absolutely a place for private credit. And now that you can access it for relatively cheap with a high degree of liquidity, to me, that's a no-brainer, at least for some appropriately sized percentage piece of your portfolio. The difference between a private credit and a traditional high yield bond might not be that direct, but I think there is certainly a differentiation there due to the fact that there are certain types of companies that will default to go into the public space to issue credit, and there are other types of companies that find it more natural to go to a private credit lender to get access to credit. And I think there's value in that differentiation.
Yeah, there's a couple of these here. Virtus private credit strategies, but actually been along longer than I thought. VPC is that one. The bond blocks one you referred to is PCMM. Now, these do have a little bit of a higher expense ratio, which makes sense because you have, like I said, this is much more labor intensive to pick these, to find these credits. And I would imagine it is a little higher risk than maybe even than high yield. Is that fair or not?
Honestly, I think it's to be determined a bit because we haven't really seen private credit as the mature asset class that it's become go through a full down cycle. I mean, COVID, you had, that few months where liquidity was an issue, but one of the different and potentially interesting things that could result in private credit actually being a bit lower risk is that it's not publicly traded in the same way that high yield is, which, if you look back to some examples of forced deleveraging, both in COVID and '08 and some periods, through the 90s and the tech bubble and all these things, if you're an asset manager or a bank or whatever, and you're managing a book of risk and you've got high yield sitting next to private credit, your private credit's illiquid. You can't really sell it. So if you're sitting there and saying, hey, I need to dump risk, I need to generate cash, to me, that results in people going to the most liquid, most easily sellable assets to dump. And, at the end of the day, the risk in credit is twofold. It's the market risk, what are people trading this at, and what is the value fluctuating day to day, which, definitively matters in terms of a context of a total portfolio. But those can be temporary dislocations. If you're willing to ride those fluctuations up and down, you're going to get paid back at par. The other risk is the permanent capital loss risk where, hey, the company physically runs out of cash, runs out of access to credit, and can't pay the credit back. In both private credit and in high yield, those are equal in my mind. So to me, it's just a question of, maybe it's not the right question to ask is which one's higher risk, but which risk is most relevant to the current situation. And in this case, I would argue, maybe not in favor of private credit over high yield, but certainly maybe put them on the same, kind of level in that sense, where I don't think it makes sense to choose one over the other. It's probably a better bet to, if you're going to make an allocation to credit, maybe split it between, the traditional high yield and maybe the more new private credit. And, functionally, both teams of issuers and underwriters are doing the same thing. They're looking at the companies, they're evaluating what likelihood they have of getting paid back and putting a mark on that in terms of, what the company's got to pay. And, if you can get high single digits out of private credit in terms of an expectation, and the company, the manager did a good job of underwriting those credits and they keep defaults low, then you're going to be in a pretty solid situation, I think, as an investor, a few years down the road.
Yeah. And interestingly, probably less correlated to equity markets than some of these other things, right?
I would say so. I think the ETF proliferation now maybe puts that a bit higher in the risk spectrum because now the ETFs trading where the underlying credits aren't. And maybe that's a proxy for, really the risk in the actual credits. But I think, to your point, these are fairly small instruments. They're I don't think indicative of the massive universe of private credit that has sprung up over the last 10 years. So, to the extent that they matter to the private credit space, I would argue they probably don't yet. Right. And you're absolutely right that the credits themselves are not going to be marked to market. They are purely going to be, these are held to maturity instruments that are in most cases held by large institutions, endowments, pensions, insurance companies with long time horizons who aren't particularly levered and who aren't going to be, in most cases, forced sellers of illiquid assets, which would, be the kind of thing that I think would cause an issue in this space if anything were to crop up.
Yeah, and some of these are actually senior secured loans, I think, even or the senior portion of the CLO or what have you.
Correct.
Yeah, so that's pretty interesting stuff there. A lot more research is obviously required, but yeah, something to think about for sure. All right, AG Giannone, I want to take a quick break and come back and ask you some more. And we want to talk about something else. The other thing that you mentioned at the outset, which is European stocks, the whole Europe trade. We're going to talk about that. We'll be right back. If you are a premium subscriber, you will not get the break. Don't touch the dial. We'll be right back. In fact, we already are. And everybody else, to become a premium subscriber, visit the website, contrarianpod.substack.com, and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Welcome back, everybody. Here with AJ Giannone, who has a orange tabby cat I've just seen on the video. If you're listening along, you're not going to be able to see it, but that's interesting. So, AJ, this is the section of the show where we ask our guests to tell us a little bit more about themselves, how they got to this station of their investing career, how their investing career started potentially, and what they're doing, how they're spending their time these days. So take it away. Tell us about that.
Yeah, certainly. My investing career started kind of right off the back of the great financial crisis. So, I was in school during that and kind of came out into a really weak job market for, investment management. And, it really forced me to buckle down and find how I could add value and break in a really, maybe non-traditional way. So I actually started at a local investment manager out here in the western suburbs of Philly. And, it was a real kind of bootstrap, smaller shop. And that was instrumental to me because it showed me, it's not just, sitting in your portfolio manager chair and buying and selling and making decisions. It's really, what is the full life cycle of a market, because it impacts investors in a really profound way. And what I learned was, no matter what investors tell you about their risk tolerance or their risk profile, when you get, a drawdown, a real panicky moment, almost everybody's going to call you and they're looking for someone to explain to them what's happening, to give them comfort, to give them confidence. And at the end of the day, my background was shaped by those moments. Those are the moments that I think define what a successful investment is and a successful investor too. So, if you've got a portfolio and you're confident in your risk profile and you've built it to withstand some of these key market drawdowns, then I think you're in a much better position than most because, from the perspective that I saw, I knew friends and family and clients who loaded up on tech names and Facebook and Meta and inevitably, had really scary moments that it turned out to not be so bad in hindsight. But in the moment, you're questioning everything. So, my investment philosophy was shaped by those moments. And I figured out, and it made sense to me intuitively, that taking a macro approach and a global macro view of what drives markets is necessary to actually successfully navigate markets and to build wealth over time. There's a ton of evidence, and you can go find it absolutely. Like, yeah, just building a 3-fund bogglehead portfolio work, sure, but you've got to have the conviction in that to not sell during the drawdowns, which are acute and which are painful. And I've found in my experience, no matter what people say during the up times, it's the down times where people maybe start to question the logic. They say this time's different and they pull the plug at the worst possible time. So, I was looking for a better protective mechanism. And I looked everywhere. I looked at, reading the technicals. I looked at leading economic indicators, building recession models. And really, what I've stumbled on and what I'm trying to bring to the market here at Allio is, a mix of both quantitative rigor in both building portfolios and making investments, as well as that human element that can kind of contextualize the current situation and say, are these computer models generating outputs and results that I think are consistent with reality? Or, are they starting to veer off into, maybe an area where we're not as comfortable? And so I think that's really the key to what we're doing and the way that I believe, the best results are produced. It's that combination of quantitative process with the human element to provide that level of context and oversight. And at Allio Capital, that's really what we're about. We're a macro-focused investment firm. We're building a robo-advisory solution for folks where they can get access to these macro strategies and these macro tools that we use to make investments on a daily basis. And to me, that's the strategy that makes sense. That resonates with me. And functionally, I think over the next maybe 10 to 20 years, I think you're going to see this process and this strategy validated because there's really no assurance that the next period is going to look anything like the last 30 or 40 years. I mean, there's a whole bunch of geopolitical issues at play. There are fiscal issues at play with the U.S. Deficit and the debt, the spiraling interest costs. There's a whole bunch of stuff that causes me to maybe question the assertion that just playing set it and forget it with low cost index funds would result in the same outcome that they've generated over the last maybe 40 or 50 years. So, with that said, I mean, I think that approach makes the most sense to me intuitively, which is why we're pursuing it at Allio Capital.
This begs the question, what kind of macro signals you do watch and what those are telling you right now?
Yeah, to me,
maybe not all of them, but
yeah. There's a lot of them. So it's hard to pick, individually which ones matter the most at one point in time. But I will say that, in an environment like now where you've got, an economy that maybe 3 months ago was just in a little bit of a static kind of run rate higher, slow grind higher, you're looking for leading indicators that would suggest that, we're about to roll over. And you've started to see a few of these, which, are certainly yellow flags or cause for concern. Declining consumer confidence is a big one because consumers who aren't confident don't make big purchases. They don't go on vacations. They don't purchase new homes or really make those necessary expenditures in the way that drives consumption higher. A lot of consumption that flows into GDP is directly tied to housing, changing jobs, buying new houses, furnishing those houses with expensive things like appliances and furniture and TVs. All of that is starting to look like it's at risk. We still have elevated interest rates, which make buying houses and moving, a little bit more difficult than they were historically. And you're starting to see that, hitting the consumer confidence side of the equation. The other piece that I think is relevant here is, the fiscal uncertainty side of it, the fiscal policy side. If we're pulling back government spending, that was another leg of the stool that the U.S. economy was standing on over the last few years was the prodigious amount of government spending that was, flowing into the economy. And at the end of the day, regardless of whether, it's the government directly spending or it's the government allocating resources to other private industries or productive enterprises in the value chain, there are a lot of downstream effects there that I don't think have yet to be felt. So, what we're looking at is really this kind of deterioration in both the soft and the hard data here in the US, which, it makes complete sense when you look at what the market's done over the last few weeks. It's this sense out there that, hey, maybe things aren't as rosy as they seem. Maybe there's a situation here where consumers stop spending. That leads to layoffs as companies don't have the demand to maintain their current levels of labor in their workforce. And that, is really the spiral that gets this thing going in the wrong direction. And then it's just a question of how long does that play out? How bad does it get? And, when you look at what folks are predicting in terms of recessionary probabilities, big banks like Goldman and JP Morgan have raised their probability of recession forecasts quite acutely over the last few weeks and months. And I think that just, kind of all snowballs together into a big storm cloud of uncertainty that to me makes it, maybe a little bit less appealing to be an equity investor here in the US.
Now, does employment follow retail spending, or does retail spending follow employment? Have you linked any kind of causality up with that at all?
Yeah, to me, it depends. It depends on there are cases in history, I think, where you will find each of those playing out in a unique way, where, maybe folks get laid off or get fired, and then obviously they don't have the discretionary funds to continue to spend. And that would be, the case with something like a 2008, where it was in fact the liquidity crunch that resulted from the home price declines. The wealth effect kind of started it all there, and now we have a situation where it's a little bit similar. Maybe it rhymes a little bit, but if you start to see, a deterioration in the market, you see this crisis of confidence, maybe home prices start to decline a little bit because housing activity cools. A huge component of discretionary spending is determined and outlaid by folks in the top income quartiles of the country. And those folks are much more likely to be impacted by the wealth effect of looking at their portfolio and their home value on Zillow than folks in the bottom quartiles. And what that means to me is that, if you continue to see this elevated uncertainty, the market not do so well, maybe home prices roll over, then these folks who have felt really wealthy over the past few years maybe feel a little bit less wealthy, maybe pull back on some of these big ticket items, maybe don't take that vacation to Europe. And that has downstream effects. Consumption declines, companies lower their earnings estimates for the year, and maybe you don't need the same amount of temp workers, maybe you don't need the same amount of a sales force or the same amount of folks in the warehouse, processing orders or, kind of contributing in that way to the lack of marginal demand on the consumption side, which can potentially create, that layoff scenario. So I think it can go in both directions. It's just, to tie it all back, like that's the benefit to me of taking, the macro approach to this is like, let's start from just ground zero, first principles, like what's happening and why, and then what does that mean? And to me, that's where we are now. Like how bad it gets, or does it even turn into a recession? It's still very much up in the air. But what we are seeing is a stark decline in confidence, a decline in portfolio values, a slowdown in housing, and all of that could potentially lead to, some more draconian measures being taken by folks, who make the hiring and firing decisions in corporate America.
Yes, indeed. Yes, indeed. All right. Well, speaking of trips to Europe that you mentioned, let's shift to Europe. And this has been a big benefit of what's happened so far in markets this year. Do you see that continuing?
I do. I think, at least in, maybe the short to medium term, I think there are still maybe some structural and regulatory issues that, preclude, some massive wealth creation boom, occurring in Europe the same way it has in Silicon Valley or here, in the US. But at the end of the day, Europe was coming off of such a low base coming into this year that it makes complete sense. I think you're seeing the effects and kind of a combination of things. It's the increased fiscal and defense spending that people are starting to acknowledge is going to be necessary, with the U.S. kind of pulling back some of that commitment there. And Europe entered the year, the MSCI Europe index entered the year at 14 times forward earnings, which, if you gave me a 14 handle on the S&P, I think everyone and their mother would run out and buy that, yesterday. But what that means is, even if you have expectations for lower earnings growth or for lower margins or kind of, maybe a worse fiscal situation at the company level, 14 times earnings is a fantastic relative value compared to 22 times earnings on the S&P. And, although we've fallen a little bit off of that, I think I checked, it was like 20 handle this morning on the S&P, you still get much more bang for your buck in an environment where, in Europe, you get generally higher dividend payments. So you're getting capital returned back at a quicker pace. And, you have a more supportive fiscal and monetary policy situation. So you've seen the ECB cut rates a bunch of times since maybe June of last year, down to, 2.5%. So you have maybe a little bit more excess liquidity in Europe, gives companies a little bit more freedom to operate. You're seeing support on the fiscal side, and you're seeing this rotation out of uncertainty into what I think folks are perceiving as a better value, at least in the short and medium term. So I would not be surprised for that trade to continue, especially if you start to see that momentum kind of continue throughout March and into April. There's nothing folks like more generally than, letting their winners ride. And there's a reason that the momentum factor exists, right? It's things that go up, continue to go up. And especially when the conditions that created that initial impulse remain, like the uncertainty here with the lack of clarity on the fiscal side, the relatively high interest rates compared to Europe, and some of the challenges on the valuation side. I think there's a case to be made that there's more room to run in Europe.
But don't most of the European companies depend on China spending and U.S. spending?
Certainly they do, and China's an interesting one as well because you've seen the China market rally, I think 20% year to date. So they certainly had their share of challenges, and they probably do still continue to struggle with some of that stuff. I think I've seen estimates of GDP growth in China, or maybe targets, whatever you want to call them, depending on how you view the quality of the data, coming down into the maybe the 4 handle range, down from the 6 or 7 handle range where you saw them in the last decade. And at the end of the day, there are, I think, there is a reworking of the interconnected, which world economies are going to contribute to all these other world economies. But these consumers on the ground, the companies on the ground need the same amount of resources. They need the same amount of energy inputs. They need the same amount of consumption to continue to drive growth, whether it comes from US or China. I think the headlines make it seem a little bit more stark, but the reality of the situation in Europe is that, yeah, maybe it's not the most dynamic, innovation, centric hub of growth, but when you can buy good companies that have proven earnings track records at a reasonable price, that is a stark alternative to buying companies at 22 times forward earnings, or, like some of these tech names where you're not going to get paid back on a, return on equity basis for 30 years.
Yeah. Very interesting. As far as the US, is there anything here that you like, or equity wise, or would you stay away?
I certainly wouldn't stay away. I think it's worthy of maybe trimming your exposure a little bit. They're, like Warren Buffett says, it's really hard to just not bet on the US given, the prodigiously profitable track record. But, to me, when I look at the US, it's tired and it's overplayed, but I'm looking for companies that have a demonstrated history of powerful earnings growth and strong profitability metrics. And if those companies are a little bit more pricey than others, I think that's a fair price to pay. So, it's the tired Magnificent Seven trade. I think you saw a massive washout from that, which was incredibly crowded by hedge funds and every retail investor in the first 2 quarters and through March. But I think you've started to see a little bit of a bottom there. And maybe if you reset those trades at a bit of a lower valuation, if you're not already so concentrated, it makes your eyes bleed. There's an argument to be made there. And, it's the oldest and most tired trade in the book at this time. But at the same time, you look at your alternatives, and I don't see too many pockets of profitability that have such a demonstrated track record of earnings growth and return on equity metrics. And you can look at areas like consumer discretionary. Consumer discretionary ETF has a higher PE multiple on a forward earnings basis than the S&P as a whole. And if we're potentially going into a recessionary period, or there's an elevated risk of recession, I don't think that's a great deal. Healthcare in particular is one where people tend to look at that as kind of a recessionary proof sector, but given the kind of maybe rhetoric or messaging we've seen from the administration, I don't necessarily think that those profits are as safe as they maybe were historically. Mm-hmm. And that's, to me, the key issue is it's not just business as usual now. You can't look at the historical relationships. And this is kind of where the quant stuff breaks down a little bit. You look at what traditionally performed well in a recession, and you've always got your utilities and, your consumer defensive stuff and your staples and things like that, all of which I think will be relatively fine. But again, you're coming at this from relatively high valuations, and it's really hard to get excited about 2.5%, earnings growth estimates, especially when you're overpaying for those to begin with.
Yeah. And some of these consumer staples are not cheap. Some are okay, but yeah, I've looked into those. All right, AJ Giannone, thank you so much for joining the Contrarian Investor Podcast today. Maybe in closing, tell our listeners how they can find out more about you, about your firm, and I will put all that information in the show notes as well.
Perfect. Yeah, thanks for having me. And for folks out there who are interested in what we're doing, check us out at alliocapital.com. We're curating a beta waitlist now. Our app's scheduled to launch here in the next few weeks and months, potentially. And we're looking forward to showing investors out there the value of a macro approach, taking a top-down view, and thinking critically and analytically about their portfolios and their investments to hopefully generate some better outcomes for folks. So thanks for having me, and looking forward to seeing how this market plays out. There's certainly a lot to anticipate.
Indeed. Yeah, Allio Capital, ALLIO. What's the origin of that name?
Yeah, so it's interesting. The founder of our company, Joseph Credante, he was a big proponent of Ray Dalio, and it's a little bit of an homage to him there. We believe in the top-down drivers of macroeconomic forces. Ray Dalio's espoused the all-weather approach, and while we don't necessarily see eye to eye in everything, it's a little bit of an Easter egg with respect to him.
Cool. All right. And any social media presence or not so much?
Yeah, you can find me on LinkedIn. I try to stay up to speed, give some comment and commentary there. I'm on X a little bit, but not as much.
Mm-hmm. Okay, cool. I'll link those as well, just so our listeners can check you out. Thanks again for coming on. Thank you all for listening, and we look forward to speaking to you again next time. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.